What is tax diversification? Let's talk about it. Thanks so much for joining us here for the Modern Wealth Management Educational Series. I'm your host, Dean Barber. We have Marty James, CPA, and a managing director of our Indianapolis office. Marty, great to have you here today.
Hey, I'm glad to be here. Kind of excited about this topic.
Well, we're going to talk about tax diversification, and people hear about investment diversification all the time, not putting all your eggs in one basket and that type of thing. Now, we don't want to get all our eggs in one basket when it comes to taxes, though, Marty, because I don't care how closely you watch a tax-deferred account like a 401k or an IRA, that account is infested with taxes that are going to come due at some point in the future, right? And so true tax diversification involves three different buckets of money, tax-deferred, taxable, and then tax-free. So as a CPA, what's your favorite bucket?
Oh, the tax-free by far. That's the pinnacle of, if you could be all tax-free, that'd just be wonderful. But, that's not always the easiest thing to accomplish. When we look at the taxable, tax-deferred, and tax-free, that's a pretty high level type thing. And the devil's in the details when we really look at each one of these accounts.
Okay.
Where people really get confused, I think, is the term tax deductible. You're filling out your tax return and you make a tax deductible charitable contribution. That's truly a tax deduction because that is never going to come back and bite you. Now, if I put money into a tax deferred 401k on a pre-tax basis or an IRA, that's not really a true tax deduction. That's tax deferred. And eventually it's going to come back and bite me somehow because I'm going to have to pay taxes on it, or somebody that is going to have to pay taxes on it.
Let's give a good example there, Marty, if we can, for our viewers here. So let's say that you have somebody that they're going to put $10,000 into their 401k, and let's just say they're falling in the 22% tax bracket. So in order to get that $10,000 in there, we'll just talk about federal tax to make it simple. Their actual take-home income won't be reduced by $10,000. It'll only be reduced by $7,800 because they're in that 22% bracket. So it's going in on a pre-tax basis. And so what you're saying is that entire $10,000 that went in, even though it was deductible in that year, it's really just tax deferred because when that money comes out, you're actually going to pay taxes on it at whatever rate you're at that point in time.
Yeah, when you're putting the money in on that tax deferred basis, you're inviting the government into your retirement plan and they make the rules.
It's interesting, Marty. You and I both been around for a long time, as is noticed by our lack of hair and gray hair here. But, remember back in the early 80s, late 70s, early 80s, when the 401k was born and people were like, oh my gosh, put all your money into this 401k because you're going to be in a lower tax bracket when you retire. And our industry actually taught us to tell people that. My industry did. And I don't know, did the CPA industry try to tell people the same thing?
Oh, it was like, pay the least amount of tax today. You would do things that not even thinking about what it's going to look like, when I retire, or even, 10, 15 years out. But yeah, that was the thing, defer, defer, defer. And the last several years, I'm talking decades, I haven't been excited about tax deferral at all.
Well, when you and I both started studying with our good friend Ed Slott, that's when the light bulb went on for me. That's been 20 years ago. And, Ed's always talking about the retirement savings time bomb and how to diffuse it. That was his first book. But in order to be able to really diffuse that time bomb, that's where the tax diversification comes in, right? You see a lot of people that have piled just the vast majority of their wealth into their 401k or 403b or IRAs, and they've painted themselves into the proverbial tax corner. And this is why we want to talk about tax diversification. And don't put your money into something until you know what the rules are when it comes to getting the money out. And that's tax rules.
Exactly. So, and we fight this every day with clients that, that we have somebody new come in and they have all this pre-tax money. We have to figure out how to unwind this tax efficiently. We have people that, we've been working with for years and we've been doing this planning. It's like my son, who's, in our office here also, he comes in and said, I feel like we didn't do as many Roth conversions this year. And we looked at it, and the reason is because we have done such a good job of doing this over the last 15 years that these clients don't have to do any more Roth conversions. They're home free.
So let's talk about the Roth conversion just a minute, because that's really your tax-free. That's you're getting yourself into that tax-free state of being there. But in order to get money into that, you're going to take it out of your regular IRA and convert it to a Roth. Well, you got to pay some taxes in order to get it over there. And you want to do it methodically over time, maybe maxing out a tax bracket or something like that. Talk a little bit about the way that you think about those Roth conversions and getting money from tax deferred to tax free, Marty. Not just all at once, but how do you really look at that over time with people?
Yeah, so we're doing, like a long-term tax projection, kind of looking out several years, realizing it's not going to be 100% correct. But at least we get a good picture of what their Social Security might look like, how with the cost of living increases, what their RMDs are going to look like. And so once we get that picture, then we can say, okay, here's how we want to attack this. And of course, we're looking at, the bracket bumping strategy, for a 12% bracket or a 22% bracket. In this world right now, maybe the 24% bracket, we want to do it. But we also have to factor in all these other stealth taxes like IRMA, the net investment income tax, that extra 3.8%. We're factoring those things in. Say you have somebody who really should be converting into the 24% bracket, but if we can do it and not have to use that full 24% bracket and still stay under those IRMA limits, that's what we're going to do. But you can't do that unless you look at it on a long-term basis.
And you would do that in the 24% bracket, Marty, if you knew that in the future that RMDs, requirement of distributions, are going to come out at a rate higher than the 24% bracket, or if the beneficiaries of that IRA are going to be forced to take that money out at a higher bracket than that 24%.
Correct. And the other thing is we're not just looking at that bracket when that money has to come out. We're looking at all the other stealth taxes too. And we do know that, something's going to change with our tax law at the end of this year. We may end up with where we're at right now. It may be slightly improved or it could be worse. So 2025 is going to be a pivotal moment for people. Once we know what's going on, hopefully we'll have some time that make the adjustments. But, Congress tends to do things in December, late December, and horses are already out of the barn. So, we're kind of planning on that sunset right now. But then again, we're trying to do it in such a way that maybe we don't have to pay, the taxes at such a high rate today if we can get it accomplished over time.
No, exactly right. And, one of the things that happens, Marty, and we get this, and why people get so bloated in the tax deferred, the regular 401k, young people that are coming out of college and going to work for the very first time, a lot of these companies now, they have this auto enrollment in a 401k, and they don't auto enroll you into a Roth 401k. They auto enroll you into a regular 401k, and there's not enough education to help people understand, man, if you're young, you should be doing everything into that Roth IRA, because you're likely in the lowest tax bracket you're ever going to be in for the rest of your life. If you're going to be in a profession where you're going to continue to grow that income over time, get that money when you're in a low bracket into that Roth IRA. Conversely, when you're in your late 50s and you're at your peak earning years, maybe you want to take a deduction and get the money into the traditional, and then think about a conversion strategy after you retire and you no longer have any income, so you get to the Roth at a lower tax bracket. Talk a little bit about those strategies, Marty, and how you think about those as a CPA.
So for the younger person, the thing they have working for them is time, and that's why that Roth is just it's made for them. And to your point on somebody gets closer, then maybe doing that, especially if you're going to wait till Medicare age to retire, then maybe that pre-tax contribution makes sense. The other thing for when we look at that, the IRAs, the traditional IRA or traditional 401k gets a bad rap because of all the infested taxes that are in it. But it's actually, for the certain clients that are charitably inclined, it's really almost like a donor advised fund. A portion of it is really, it goes in, it's kind of like almost like a HSA thing, tax deductible going in, tax deductible coming out. It doesn't land on your tax return, doesn't increase your modified adjusted gross income. So it helps in a lot of other situations. So you got to be cognizant of what's this person's charitable intent.
Yeah, I was gonna mention that earlier whenever you talked about doing Roth conversions and why you may not have done as many. You say, well, we got to where we needed to be. And in a lot of cases where people are charitably inclined, you never want to convert all of that IRA money, because you want to use that IRA money to go directly to charity without it ever hitting your tax return. And that's ultimately the most efficient. I'm glad you brought up the HSA as a tax-free asset. You and I did a whole program on how people misunderstand HSAs. Talk a little bit about that HSA, Marty, because that's the one account that you can get a tax deduction when the money goes in, a true tax deduction, and then the money comes out tax-free when it's used for qualified medical expenses. So talk about how a person should be using that tax-exempt account.
Yeah. So what I recommend doing, especially if you have the cash flow to do this, what a lot of people do is they use their HSA as an impress fund. They put their money in, they pay out their current medical expenses. Really what you should do, especially if you're younger, is you fund this thing, don't take distributions out of it. You invest it instead, just like you do your other retirement accounts, but keep a record of all your out-of-pocket medical expenses. 15 years from now, I can reimburse myself from that or longer from that HSA for these expenses I incurred, now. And that's totally tax-free money. But in the meantime, I got all that tax-free growth going on inside there.
Yeah, that's a beautiful thing. All right, let's talk about the one that people don't talk about much, Marty, and that's the taxable account and why it's so critical to have money in a taxable account. And look, here's the thing. I just want to put this out there. When you start taking income in retirement, I always tell people you have more control over taxes during your retirement years than you have any other time of your life. And if you've created good tax diversification, you've got money in the taxable account, the tax deferred, and the tax-free accounts, it's how and when you spend money out of these different accounts and how you pair them together that really will dictate the amount of taxes you'll pay on a year-over-year basis. But having money in that taxable account, Marty, is really important in the early years of retirement to begin doing those conversions because you got to have some money to live on.
Right. So again, it's like we can use that to live on. In addition to that, we have a pool of money here to pay the taxes on so I can get the most money into my Roth conversion. So let's say I did a $100,000 Roth conversion and I was over 59 and a half. And I said, well, I'm going to withhold the taxes on it. So I only got $75,000 in my Roth, but I had, $100,000 in a taxable account. Well, if I would have paid that $25,000 with my taxable account, put the full 100 into my Roth, I've accomplished a couple things there. Now I have much more tax-free growth going on in my Roth. I got the most money in there as possible, which is also in most states a very protected state as far as creditors and such. But the other thing I accomplished is I reduced the amount of current taxable income that taxable account is producing. So clients, they should be doing if they can make a Roth contribution or backdoor Roths or whatever, they should be shifting money from that taxable account into that strategy and ultimately get it to where it's in a very protected tax and asset protection state.
Yeah, and Marty, so it's really a key, right? So when we're planning to get people to and through retirement, we know that taxes are going to be one of the largest wealth eroding factors facing people in retirement. As long as you live in the United States and have money or make money, taxes are going to be a factor of your life. So we start out in the planning years early saying, all right, what's going to be our distribution strategy? And of course, we know that Congress is really good at continuing to change the tax code, but we have to do our longer term projections as if the tax code's not going to change. But if the tax codes do change, then we adapt and we do what we need to do. But its idea of tax diversification is really building all three of those buckets, not having too much in any one bucket so that you do have ultimate flexibility in retirement.
Right. Because what you're doing, say somebody rolls into retirement and they have all three of these buckets. I may take a little bit of out each account of my living expenses. And my goal there is what I'm trying to do is just smooth out their tax bracket, through retirement without these huge spikes.
You and I talked on a previous program about doing a Roth conversion in a 401k plan, maybe a year or two before you retired. And the idea that you had there is allow yourself, especially if you're going to retire pre-Medicare, to qualify for the Affordable Care Act subsidies. Talk a little bit about that, because that's a huge thing where I don't think a lot of people think about this or really understand how this works.
Yeah. So what keeps most people working, if say they could retire at 62, but what keeps them there is the health insurance from the employer. But we have, the ACA, the marketplace that's available to them is fairly expensive, high deductibles and such. But Congress when they put it in, they gave us these tax credits based on your income. And the lower your income, the more of these tax credits you got. So it's possible that, instead of paying $20,000 for a couple, they're paying like $900 or $600 or even $300, for the premiums because of these tax credits. When we factor in it, let's say I go into retirement and all my money's in pre-tax, I got to pull it out to live on. I'm going to increase my income, and I'm also going to increase my premium, what I have to pay, because I'm not going to be able to get these credits. The idea is before I retire and before I'm on the ACA, I'm going to do a large conversion if I haven't already started planning for it like 10 years ago by funding, my Roth deferrals. What I'm doing is I'm creating this pool of money that for those next 3 years or whatever it is that I have to bridge to Medicare, I'm going to spend that down. And sometimes when you're doing the math on it, it makes sense to go ahead and cross over that higher tax bracket because of that premium cost is so high. I'm still saving money tax-wise.
Yeah, and you could really do the same thing if you had enough taxable money saved. I love the Roth, though, but if you have enough taxable money saved, you can actually live on the principal of that taxable money, not causing, that income to blow through those limits so that you don't qualify for those ACA credits.
Right. At that point, you're just really worried about what capital gains am I generating here that could actually, create that issue.
Yeah.
Yeah. But yeah, definitely having that taxable money helps.
Yeah. And so again, just kind of recap here for people, tax diversification is key to keep you having the biggest possibility of paying as little tax as possible over your lifetime. And it's really a good certified financial planner working with a good CPA, which is what we do here at Modern Wealth, of looking at your overall situation, looking at all your resources, and then helping coach you on where you should be putting money in and what tax bucket should you be funding and how much in each tax bucket. And it's all designed to do what we talked about earlier, allow you to pay as little tax as possible at the point in time when you have the most control, which is during your retirement years.
Yeah. So I want to go back to this taxable account here. What some people will do is they'll just go into like an index mutual fund and just plow money into that. And then thinking they're going to use this, early in retirement. But the problem is they haven't managed the unrealized gains in there. Say they're reinvesting their dividends and capital gains. They put $100,000 in, and over time, it's now worth $150,000 as far as cost basis. But the account is now at $300,000. Now I have to unwind this in retirement. And so actively managing that cost basis in your gains, whether you're harvesting losses or harvesting gains along the way, depending on your tax bracket, can actually, help that a lot. But a lot of people, we come across this all the time. They've just been, for 20 years, putting money into that index fund, where there's strategies that you can, mitigate that problem with.
Yeah. You're talking about the strategies of custom indexing, where you're owning the individual securities as opposed to the index itself, and then actively looking for tax loss harvesting opportunities through time. So where the goal is to mirror the return of the index, but actually have tax losses that are piling up so that in the event of capital gains in the future, those tax losses will offset those future gains. So it's a beautiful thing. And I think they estimate that the tax alpha on that is roughly 1% a year in additional return because of the tax savings. And so, it's a big deal. And the thing is that it used to be that those accounts, you had to have a pretty high minimum to get into, but, we have arrangements now where we can do those accounts for as little as $100,000. So it is a great strategy, Marty. I'm glad you brought that up. And another thing on the tax-free bucket, I think is worth mentioning as we are here in mid-November of 2024, interest rates have done us a favor and allowed us to look at the tax-free bond market in a very different way, different than we've looked at it for almost 2 decades. You can actually make money now in tax-free bonds, and it's super attractive. And that's another way that you can position those taxable assets in a very tax-efficient way.
Right. When you say tax-free bonds, municipal bonds, the interest and all that's taxable, but you do have the opportunity for, long-term capital gains with where interest rates are today, if they would fall. So, and long-term capital gains are taxed much more favorably than ordinary income.
Yep. Well, Marty, I appreciate you taking time to join me here on the Modern Wealth educational series. I would imagine that we're going to see some changes in the tax code in the coming months. And as those unfold, we'll be here to share our thoughts and what we see with all of our viewers. Thanks, Marty. And if you like this video, please like, share, and subscribe.